A big hello and welcome to RJS TV. It's the June edition. There's been, unfortunately, more interest rate rises. We've got weak economic growth and there's general uncertainty out there in the community. So there's never been a more important time to discuss some of the big issues with Roy Sanderson. Roy, we sit here after another rate rise. How's the mood in the community at the moment that you're speaking to?
Yeah, it's a lot of uncertainty, not confident at all where the world's at right at the moment. And it's not being caused by wars like we were discussing, 6 months ago. It's by factors right here in Australia.
Yes, I don't think that Philip Lowe thought he was going to be a household name at the start of this year, but he certainly is now, and people watch on that first Tuesday in every month with eager eyes, and unfortunately there was bad news for them as we get into our news headlines, because before we get to interest rates, we'll start with economic growth, Roy, which was announced yesterday, and it is weak, 0.2% for the quarter. And it was below the market forecast of 0.3%. So this delicate juggling act that the Reserve Bank has undertaken to try and keep Australia out of recession is really on tenterhooks at the moment.
Yes, and we know that a recession is defined by two negative figures in a row, and that 0.2% positive, so that's a plus, but immigration this year's been 400,000 people. Pre-pandemic, it was 235,000 people. So we've got huge immigration, and if it wasn't for that immigration, that would have been negative.
Concerning figures, and I think that we're going to go into more detail about economic growth and how we can stimulate that later in the show. But as we mentioned, interest rate now at 4.1% after another rate hike. It's been a 400 basis point rate increase since May 2022, Roy, and the pain is being felt by mortgage holders, particularly new mortgage holders who borrowed just a year ago at 4% less than the current rate.
Yeah, and we're going to talk about fixed rates, but yeah, there's a lot of pain out there with this extra increase.
The monthly CPI indicator came out and it indicated an increase in inflation. Now, Roy, I don't profess to know the answer to this, but there's mixed reports as to the legitimacy of this number. The ABS reports inflation in two different ways. There's a monthly CPI indicator that has, or that effectively takes in a basket of goods with fewer goods, and then there's the quarterly number, which is more comprehensive. This was the one that was, or that is apparently slightly less comprehensive and therefore has more volatility in it. But what it does say is that there is inflation at 6.8%, which is still quite high, and it was enough to push the Reserve Bank and the Governor, Philip Lowe, to increase the inflation rate.
And interestingly, Dave, that inflation rate was a big surprise, and yes, it does mean that interest rates were going up, but interestingly, in that inflation rate, gas went up by 14.3%, which is a real concern.
So, Roy, with this rate rise, what does that actually mean for current mortgage holders and borrowers?
Well, we'll see here that there's 800,000 loans which are going to come off fixed rate between now and the end of the year. And this has come from the Reserve Bank. So most of these borrowers have borrowed at somewhere around the 2%, 1.99 to 2.29. Their rates, when they come off fixed, are going to go to around 6%. And when the banks assess whether they can afford the loan, APRA are using a buffer of 3%. That used to be 2.5. So we've exceeded that 3%, and most people who are coming off fixed rates probably can't theoretically afford their loan. So we have a real problem. There's lots of mortgage stress that's going to hit between now and Christmas this year.
Oh, and one of the solutions proposed to that, Roy, is to just use your savings to pay off those new increases. Well, CommSec confirming that that's not going to be possible either for most households, because household savings are now at a 5.5-year low. Boy, wasn't that quick, Roy. It wasn't that long ago on this show that we were talking about record household savings, as you can see there in 2020, which I think talks to the longevity of this show, I might add. But you know, suddenly here we are with 5.5-year lows on household saving, which is really concerning.
Which means that people are going to start spending less because we've got less spending, which means inflation should come off the boil a bit. And I'll give you 2 life examples. I caught an Uber this week and it was 5:30 in the evening, and the Uber driver said he normally works through till 9:30. I said, what about tonight? He said, I'm knocking off now, 5:30, because there's no work for him. I've got a pizza shop client, not selling any pizzas during the day and a lot less than normal in the evenings. He's gone out and got a part-time job during the day so he can just keep his pizza shop open at night. So I know they're only 2 examples, but on the street, people are hurting.
Yeah, and we're going to have a look at that consumer confidence number, which confirms that later on in the show, Roy. Now, a bit of a surprise here. I wanted to do this because it's contextually relevant at the moment. Let's get into an early edition of Roy's Rage, because you've got something that pertains to interest rates, inflation, etc. Roy, what have you got for us today?
Well, we've talked about interest rates and we've talked about inflation, and I've got a way to fix inflation without increasing interest rates. And here's a list of 6 points that I think the Reserve Bank need to take on board and just put aside the interest rate increasing structure that they've been doing. We need to reduce government spending, and unfortunately we've had a state budget and a federal budget that is increasing our deficit, which means we're spending more than we're earning, so they haven't done that. We need a super profits tax, and I don't mean superannuation. I'm talking about profits over, I don't know what the figure should be, 1 billion, and instead of paying 30%, you pay 35% for anything over $1 billion or 10 million, I don't know, but we need to increase taxes. And we need to reserve some gas for Australian domestic use. We're exporting it all, and I mentioned earlier that gas has gone up 14.3% in the last inflation figure, so that's no good. And the other points there, you know, wages, bring back the fuel excise cut, and reassess the target for inflation. Who invented 2 to 3%? Maybe it could be 5% or 4% or 6%.
Roy, you know, linked to all of this and the Reserve Bank's explanation is this idea of productivity. And, you know, let's have a look at this productivity. So the Reserve Bank Governor, Philip Lowe, has blamed the increase in wages with lagging productivity as one of the inflationary effects and thus creating a higher interest rate rise. And you can see there, the point here is that wage increases are outpacing productivity in this last couple of years. But one thing that has come out yesterday as part of the OECD report is that they've suggested that it's not it's not wages that are causing inflation. It's in fact profits that are having a bigger impact on inflation than wages proportionally. So to me, I think your point on a super profits tax is the right one, Roy. We can see here if you index profits versus wages since the turn of the century, profits are outpacing wages exponentially, particularly over the last few years. So implementing a tax which takes money out of the economy and takes money from some of those excess profits may have an effect that helps reduce that inflation number. So I think, you know, off the back of what you said regarding a profits tax, it seems like a solution that would, in fact, reduce that inflation number.
Agreed.
Consumer confidence is next. And Roy, just have a look at this. I want to take us back a step on this because we look at this number a lot, but perhaps we don't give enough context to it sometimes. You see there in February and March, we had back-to-back readings of 78.5, which is near historical lows. Do you know when the last time, Roy, we had back-to-back readings under 80 was?
I have no idea.
Perhaps you'd think it was at the start of the pandemic when there was complete calamity and uncertainty. Perhaps you'd think it was at the height of the global financial crisis when the banking sector was completely in turmoil and people were freaking out about their savings. You'd be wrong if you suggested either of those, Roy. In fact, the last time we had sub-80 back-to-back readings of consumer confidence was in the deep recession of the early 1990s. So we are starting to get to a point where, these measures that we're talking about are generational in their nature, which is very concerning. And I think, that is franked by what you said earlier. You're starting to see people in the community change their behaviours as a result of economic conditions. Personally, in my lifetime, as a 30-odd year old, I don't remember that. I actually don't remember this idea of people actively changing their behaviours and habits as a result of economic conditions. Obviously, I've seen isolated instances of it, people losing their jobs in particular sectors or people doing this. But this sort of widespread interference into the community of poor economic conditions, I haven't witnessed this, and I've started to witness similar things to you.
Yep.
I think the other number that we look at here is business confidence. It's flat. It's going to be very interesting to see once they announce their May number, because, as I say, at the moment, it is on zero and flatlining at the moment. I think it's a watch this space. As we know, businesses factor in a lot of this stuff a lot earlier than consumers, so watch this space on business confidence. The stock market, Roy, the ASX 200, what's it been up to lately?
Yeah, I just wanted to show 3 quick graphs here. The first one is 1 month. You can see that we started the month at about 7,225. We finished the month also the same. So 1 month, completely flat. Look at the next graph, which is 12 months. We started the year at 7,200. We're finished fairly similar. So despite what's happened over 12 months, so you would argue that the last 3 months and the last 12 months not been very good for the stock market. I know our wealth management team, they don't select the 200. They select the best 20 or 30, so they get very good returns. But if you look at the last 10 years, this is the trend. So if we've had a flat 3 months and a flat 12 months, at some point in the very near future, it's going to be a great time to be investing in the stock market.
What about the property market, Roy?
Yes, we have a slide here. Interestingly, that the property market has increased. Here's Melbourne on New South Wales and Victoria. New South Wales jumped up over 1.6%. That's extraordinary in the month. That's May. Now that says that house prices are going up. That's what it's supporting.
And what do you think is driving those changes in house prices, Roy?
Well, we'll see here. I think there's lack of supply that we've talked about. There's immigration of 400,000. We've got less properties on the market for sale right now than previously. In fact, we are way under the 10-year average that we show there on the left-hand side. And the rentals are going up because we've got a shortage of supply. We have a housing crisis looming. It's on our doorstep, and I don't understand that the government aren't seeing what we see. But you can see what the rental growth has been in Sydney and Melbourne and Brisbane, quite extraordinary.
So it begs a question, Roy, particularly for people looking at investing money, stock market versus property. Is it still worth being a landlord?
Yeah, well, we have a webinar that we ran, and it's on our website. You can hear the webinar. It goes for about 30 minutes, and there's a number of property experts talking about commercial and residential. And have a look at that. It's from our website. I've just put some snapshot points there. Given that there's 2 million private landlords, 80% own one property, and 50% are negative geared, which means negative geared means the costs are more than the income. So people are relying on capital gain to make money. And that's okay because they're wanting to create wealth while they get a tax deduction. But is it worth being a landlord, given compliance costs, interest rates, inflation, all the things I've listed there, and legislative uncertainty, given that the Greens are out there saying that we should have a cap, a freeze on rentals and then a cap for 2 years. So have a look at that webinar, go to the website.
rjsanderson.com.au. Roy, I fully agree that there is a housing crisis on its way. In fact, I think it's here right now. Let's have a look at the building approvals rate. It's low. You can see there it's as low as it's been in the last decade or so. And that is the total dwellings approved in Australia. So we've got a supply issue. Now, I want to talk about one of the reasons we've got a supply issue. Yes, there is supply shortages, there is building and construction industry businesses collapsing, But another one is this. Roy, have a look at this map of New York City. Those are the heritage overlays, and there are 33,000 of those heritage overlays.
33,000?
In New York City. You were there recently. There's
Yes.
some nice buildings to protect.
Nice
there.
buildings to protect, yeah. I was on a study tour,
They're
if the tax office is listening.
They're quite tall, and there's plenty of people that live in most of them. How many do you think there are in Melbourne?
There wouldn't be more than 1,000. 33,000 is ridiculous.
Try more than double. There are 82,000 heritage overlays in Melbourne, which means that the layers of bureaucracy that people need to go in to build over the top of them is significantly increased. Roy, what that's doing is it's pushing people out to the suburbs, and it's creating things like this. These are housing estates that are a long, long way from the city. Now, this is what the Australian dream is currently. You can live in one of these estates and you can drive a round trip of 3 hours into the city each day for the rest of your life until you've paid off your mortgage that you're probably paying only interest only on at the moment over 35 years. Now, to me, that's not the Australian dream. I don't see that as a relevant Australian dream for young people, particularly my age. And I think that Australian dream needs to be redefined. So this is my housing solution, Roy. Not everyone's going to agree with it, but I'm going to put it out there anyway. First and foremost, there needs to be an overhaul of local and state government planning laws, okay? This market needs to be deregulated. We need to get rid of some of these heritage overlays that are currently sitting on colonial mansions in the inner city suburbs. City of Yarra, we're talking, City of Stonington, City of Boroondara, City of Melbourne, we're talking about those places. And we need to start building medium to high density housing. The government needs to run a campaign to make that sexy. We need to change the hearts and minds of Australians to make medium to high density housing sexy. We also need buy-in from the private sector. We need them to have an innovation summit. We need them to start thinking about, okay, how are we going to go from building houses to building high-rise apartments that are sustainable, that are comfortable, that are attractive to live in, because at the moment people don't want to live in those things, and I get that. There's a high density housing in Australia culturally has not been accepted, and that's probably because of the quality of it. So people moving out to the suburbs, what does that do? It puts enormous pressure on costs on governments from a cost perspective, because sprawl happens and therefore services need to be extended further out. The train line needs to be pushed out, the tram line needs to be pushed out, hospitals need to be built further out. And also, it starts to interfere with the green wedges that I think has been a brilliant piece of policy. So these are the benefits of medium to high density housing. We can reduce government spend on costly infrastructure sprawl. We can maintain those green wedges in city surrounds so that people have parks, gardens and areas of green space to work and operate in. We can provide opportunities for the existing workforce. They're already there. We're building so much stuff. We're going to change Victoria's big build to Victoria's big housing build. And in doing that, we can see Australia go from just a minerals and commodities exchange to a leader in medium to high density housing that is sustainable, that is climate friendly, that is attractive for people to live in, and we can export those services and start to derive economic growth from that. That's my housing solution. Not everyone will agree with that, but I think it's time to make medium to high density housing sexy, Roy.
Great work, Dave. We not only identify the problems on RJS TV, but we also come up with the solutions.
Speaking of solutions, you've got a tax tip for individuals and for businesses today. What have we got for us? Or what have you got for us?
Yeah, I've listed out a few tax tips, but I'll maybe comment on one in particular, the middle one, which is co-contribution. It's not well known. If you have an income, this might be a partner, but it might be one of your children, might be working at McDonald's. And if the income's under 42,016, you can deposit $1,000 into a super fund and they get a co-contribution from the government of $500. That's a 50% immediate return, and that is something, that's a law that's been around for a while. It's not well known, but it's certainly one that I think people need to be alerted to.
What about on the business side, Roy? What have you got for us there?
Yep, so on the business side, I've listed out 4 tips there. I think that they're all important, but the main one I'll mention is number 3, instant asset write-off for cars and equipment. It's very important that the delivery arrives before 30th of June to claim it in this tax return. I had a client ring me during the week. We had a chat. And he said he's getting his new car on the 29th. And I said, gee, I hope there's no delays. He said, oh, there's already been delays at the docks, but he'll get it on the 29th. But if something goes wrong, he doesn't get it till the 1st, he cannot claim it this year. So important that you spend the money and get delivery of whatever the vehicle or equipment is before 30th of June.
Is there a way you can protect yourself on that front, Roy, or is that basically just luck now? Can you strike up an agreement with the supplier, or is that...
Well, you can. I know that when I was in industry working full-time and we had a fleet of about 35 cars, when we purchased a car, we actually put a condition that had to be delivered by a certain date because our team of workers needed it. And if it wasn't delivered by that date, we had the right to cancel the contract. I don't know if that still goes on today, but what it did mean is that we were never pushed out to next month or the month after, whether it's the car yard's fault just selling it to somebody else or whether they don't have supply, but it meant that we could go to another car yard and buy something else.
Protect yourself against that, because the difference could be enormous, as you mentioned, Roy. Hey, Roy, we love a shout out on this show. Who have you got for us, or what have you got for us today?
We've got D'Angelo Wines. That's Benny D'Angelo there looking in his splendour, and he has a special on for June, which says if you go to his website, you will get 30% off red wines. Great winery. Their cellar door is awesome. Their tapas bar and his pizzas are fantastic. They're based out in the southeast suburbs, just the other side of Berwick, in Officer, and seriously great business. So go Benny and jump onto his website and support a small business. We love them.
I was just talking to the team out the back about tapas and what a great offering it is. We might have to have a little RJ Sanderson catch up there at D'Angelo's at the end of this year, Roy. That is the end of this show. It's been heated. Let's take a deep breath, because we want to give people some hope on the way out. What do you make of next month? What are we going to be sitting here talking about next month, Roy?
Well, I'm hoping we won't have interest rate increases this time next month. I'm hoping that the Reserve Bank will watch our show and learn a little bit. I will be surprised if consumer confidence and business confidence increase, because I'm not feeling very confident out there at the moment with the way the public are. So it'll be an interesting month.
So if you were to give any advice to the punters out on the street, about what to do with their money over the next month, what would you say to them?
Well, what would you say? Get advice on what you invest in. So if you're going to invest, I would be investing. I'm not sure property is for everybody right at the moment, despite the fact that we've just shown that property is going up. I would go talk to a wealth manager, whether it's at RJS Wealth Management or another wealth manager firm, but I'd talk to somebody to get some advice on what you should invest in so that you can plan for your retirement and beyond. That's what you should be doing.
Thank you, Roy. It's been another belter here on RJ Sanderson TV. Make sure you visit the website for more information, www.rjsanderson.com.au. Thanks so much for joining us. We'll see you in July.